Lockheed Martin Corporation, stock ticker LMT, is trading down quite a bit on the day. We can see they're down around 6.3%, currently trading at $576 per share. Now, over the past year, they've done pretty well. They're up around 29%. If we look at them year to date, up around 27%. But in the past month, we can see there was a jump up in the share price and then a huge sell-off. And this sell-off comes after releasing their latest quarter's earnings report. So let's go ahead and jump into this and see what's going on. If we scroll down, we can see Q3 non-GAAP earnings per share of $6.84 was a beat by 40 cents. So that's actually a pretty nice beat on the earnings, but revenue was a miss. We can see it was up around 1.3% year over year, and they missed by about $270 million. It came in at about $17.1 billion. So this led to a huge sell-off, as we can see right here. If we scroll down here, we can see shares fell as much as 5.7% in the first couple of hours after they reported disappointing sales growth. Now, I've dug quite a bit deeper into Lockheed Martin and this recent earnings report, and I do think this huge sell-off may be a little bit of an overreaction, and I want to show you why in this video. So let's go ahead and start digging in. Now, to start off, let's start to understand the dividend metrics behind this company a little bit better. If we jump over to my dividend breakdown sheet, come up here and plug in LMT, and you can see all this data is going to load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, what we can see here is the starting dividend yield for LMT is modest. It's sitting at about 2.29%. But there's a few different reasons that a lot of dividend investors actually like this stock. Now, first off, we can see pretty rich history of increasing those dividend payments over the past decade. The 10-year dividend CAGR is sitting at about 9%, so that's pretty solid dividend growth during that time. And keep in mind, they did just recently increase that dividend payment again by about 4.8%. Now, this dividend hike is a little bit lower than their 5 and 10-year averages, as we can see right here. The 5-year average is closer to 8% and the 10-year average closer to 9%. So yes, it was a lower dividend hike. But keep in mind, dividends aren't always the main way that this company rewards their shareholders. They also buy back shares pretty heavily. And in fact, if we jump over to their most recent earnings release and scroll down to the fourth slide, we can actually start to see this. If we look at third quarter 2024 financial highlights, we can see they paid out about $0.75 billion in dividends, while share repurchases was sitting at about $0.85 billion. Now, share repurchases can be a really good way to reward shareholders in the right context, and I want to take a moment to look at this just a little bit closer. If we jump over to my Bogle's valuation spreadsheet, looks like there's a lot going on here, but what we really want to focus on is going to be the shareholder yield. Now, shareholder yield is simply combining the dividend yield with the buyback yield. And you're probably familiar with dividend yield. It's pretty much just how much the company's paying you out in dividends. And for example, like we pointed out, LMT is coming in at about 2.29%. So if you invested $100 into the company, they'd pay you about $2.29 in the first year and then continue to increase that dividend over time. But the buyback yield is going to be a little bit different. It's telling you what percentage of the shares the company is actively buying back. Because keep in mind, if you own this stock and they're buying back their stock, you're going to own more of the company over time, and it's also going to boost all of their per share metrics. So again, this can be a good way to reward shareholders. So if you want to get the full picture, a lot of the time shareholder yield can be a great way to get a better understanding of how much the company is rewarding their shareholders. So again, dividend yield sitting at 2.29%. But what is the buyback yield? Well, we can see the average buyback yield for this company over the past 5 years is sitting at about 2.51%. But look at this. Share buybacks have really ramped up over the last couple of years. Looks like in 2019, 2020, and 2021, it was sitting closer to about 1% in those years. But over the last couple of years, they bought back around 5% of their outstanding shares. That is a lot of stock buybacks. And they have plans to continue to buy back stock. So let's say that the buyback yield is going to be a little bit lower than that. Maybe it'll be around 4%. Well, we can see the shareholder yield for this company sitting at about 6.29%. So this company is heavily rewarding their shareholders with dividend payouts and buying back stock. And if we jump back over to our dividend breakdown sheet, we can see this is actually pretty sustainable because the free cash flow payout ratio is only sitting at about 49%. So they still have a little over 50% of their free cash flow to do things like buy back shares or pay down debt or reinvest back into the business. And we can see free cash flow over the past few years has grown quite a bit. In 2021, it got as high as about $7.7 billion. And keep in mind, in 2013, it was sitting at about $3.7 billion. So over the past decade, it's done a decent job of growing. And at the end of 2023, it was sitting at about $6.2 billion. But one of the things we also have to keep in mind is this free cash flow from this company. The free cash flow they're generating is very recession resilient. And why is this? Well, you have to understand Most of the revenue the company brings in is coming from government contracts, and like I've said before, the government is not afraid to spend your money. So for example, look at some of the revenue segments. If we scroll down, we can see aeronautics, we can see missiles and fire control, we can see rotary and mission systems, we can see space. The government is going to continue spending money on defense regardless of what's going on in the economy. And that's why so many people consider this company recession resilient. And so when you combine the fact that they're directly rewarding shareholders with buybacks and dividend payments, growing dividend payments, you can see why some people start to find this company attractive. Now, what's really interesting about the sell-off after this recent earnings report is if we scroll down, we can get the updated 2024 outlook, and we can see what it was prior right here. For example, sales. They're expecting between 70.5 and 71.5, and now they're currently projecting on the upper end of this at 71,250. The same is true with things like segment operating profit, diluted earnings per share, and they're even projecting on the higher end of free cash flow. But again, like we saw despite this, shares sold off quite a bit. But now let's get a better picture of the financial outlook of this company over the past decade, and we'll jump over to my stock screener and plug in LMT. And we can quickly start to get a few key insights. And first off, when we look at top lines like revenue per share, one of the things that's really attractive about this company is the consistency you see with revenue per share. It's not only growing, but it's very stable and predictable. A lot of investors really favor stability and predictability. We can also see earnings has grown quite a bit over the past decade, going from about $9.29 to in 2023, $27.65, and the same is true with free cash flow per share. We saw quite a dip in 2018, but overall the growth has been pretty good. Now, like I already pointed out, they're buying back a lot of shares. They've gone from around 321 million all the way down to about 250 million in 2023, and obviously when they report Q4 earnings for 2024, we'll see this is quite a bit lower. And then finally, one of the signs of a quality company is high levels of return on invested capital. This is telling us how profitable are the projects the company is investing their capital into. And keep in mind, like we saw, they only have around 51% of their free cash flow left over after paying out dividends, and then they have to perform their share buybacks. So it's not like they're using most of their free cash flow to reinvest back into the business, but the free cash flow they are using to reinvest back into the business is generating really good returns for the company. We can see since 2018, the company has consistently had return on invested capital of at least 29%. That is really, really good. So even though they're not using most of their free cash flow to reinvest back into the business, I still expect them to continue to grow free cash flow at a decent rate because they're getting such high rates of returns when they do reinvest it. And then one of the things I want to glance at on our profitability and income statement sheet is gross profit ratios have actually been increasing over the past decade. Look at this trend. We can see after 2017, the gross profit ratio took a jump up all the way to around 13.71%, and at the end of 2023, it was sitting at about 12.55%. So it's quite a bit higher than it was in the early 2013s through 2017. And then if we look at the balance sheet, there's a couple quick things I want to point out. First off, current ratio is sitting at 1.3. Now, current ratio is simply your total current assets divided by total current liabilities, and it helps you understand how easily can the company meet its short-term obligations. And typically, we want to see this above 1. And they're sitting at 1.3, so they're in pretty good shape. And then we have our debt to assets ratio. This is simply our total debt divided by total assets, sitting in very good shape again at 0.35. So when you go through the financials and the earnings report for this company, you can see there's definitely a reason that a lot of investors actually really like this company. No, it's definitely not some high-flying growth stock or even a mega dividend growth stock, but they're definitely recession resilient with their revenue coming in from the government. And they do a pretty good job of rewarding their shareholders, and they get high levels of return on invested capital. So the question we have to answer is the company trading at a good value at about $575 per share after the earnings sell off at about 6.5%. And to answer that question, let's go ahead and jump over to my stock valuation spreadsheet and come up here and plug in LMT. And once this data loads in, the first thing I want to point out is if we come down here and look at the company's beta. This is a measure of the company's volatility in comparison to the market. So the S&P 500 has a beta of 1. So if you see a beta of below 1, it means the company is less volatile than the S&P 500. And LMT is sitting at about 0.47. So you're looking at very low levels of volatility. So you begin to understand what type of investors love this company even more. Low volatility, recession resilient, and good about rewarding shareholders with buybacks and dividends. Now, if we go ahead and jump over to our first valuation, our discounted cash flow analysis, we're going to try to see how much the company is worth based on how much free cash flow they're going to produce in the future. So we can see historical free cash flow numbers here. And then we have our free cash flow growth rate projection. Now, it's not the highest, it's coming in at about 6%. So we're projecting that free cash flow growth rate to the future free cash flows of the company, finding their present value and adding them together here, adding their cash and cash equivalents, subtracting out total debt to get equity value. Once we do that, we divide by shares outstanding and we come to a DCF price per share of $530, a little bit below that current trading price. Now, if we look at the multiples valuation, what we're doing is we're seeing how the market is valuing companies that are somewhat similar in structure. Now, there's no perfect comparable for LMT, there's no doubt, but again, we're getting as close as we can, but we can see the average price to earnings multiple for these companies is sitting at about 22.9. If we apply that same price to earnings multiple to LMT, we'd come to an intrinsic value of about $633 per share. Now, the last valuation we'll look at is going to be our dividend discount model. And basically, we're valuing the company based on how much they're paying out in dividends and how much that dividend is growing. And so, assuming a dividend growth rate of about 5.5%, which remember, that's a little bit below what we've seen for the 10 and 5-year average, but it's closer to their most recent dividend hike. But again, assuming that 5.5% dividend growth rate with a discount rate of 8%, we come to a dividend discount model of $557 per share. So when we jump over to the output tab and average the three valuations together that we just used, we come to an intrinsic value of about $573.50 per share. Now, the current trading price is actually right at the intrinsic value, it looks like. It's very, very close. Maybe the closest that I've seen since making these valuations, but with a 10% margin of safety, we come to an acceptable buy price of about $516 per share, so it's not quite in our buy range. So it looks like maybe a little bit of a sell-off could be justified, but I do think this company a lot of the times might even trade at a slight premium for the reasons I listed earlier. It's considered very recession resilient. They do a great job of rewarding shareholders, and it has low levels of volatility. Most of their revenue comes from government contracts, which is a huge plus. So while it looks like the company's pretty much trading at fair value, if you bought in right now, you definitely wouldn't be getting much of a margin of safety. But again, keep in mind, like we saw on the stock screener over here, there's not a lot of volatility with the company. So go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. And again, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.